Hey everybody, this is David Skarika. This is our free update. Today we're going to look at gold and actually the seasonality of the stock market. Obviously, gold had a big move on Friday. I did a quick stock chart of the day on the weekend, just the chart itself. So let's get right into it here. I got a lot of work today. I'm doing this on Monday. I have like 3 or 4 of these I have to do, some for private clients as well, like these videos, etc. So, we're also going to show you some interesting news from one of our client companies, our sponsors. So gold right now is getting back here. We're down a little bit today, but we've kind of come back here. We've had this nice little rally, and again, we go look. I've talked about that seasonality. We go look at even like 2021, 2022, and last year, even in years where gold hasn't started a big multi-year bull market, but is kind of in this range for the most part in that fourth quarter into the spring of next year, you get a rally. Even last year, you can see, even in 2020, when gold kind of peaked in the middle of the year, if you had still bought in the fourth quarter, you still would have been up into the spring of the following year. It wasn't a huge gain, but it was up. So usually this seasonality works, and you can really see it work in when gold's in a big gold bull run, like you can see 2020, 18, and then 2019 to 2020. So that's usually when it works. I think we're finally close here. We had this triple top. I'm showing the GLD, but in gold, it was around 2,100, and the GLD is around 190 to 195. We're only about 5 to 10, excuse me, points below that. So I think if we can break this kind of triple top, we'll be off to the races. As I've shown in the past, we'll get a 10-year chart here. You'll see on the 10-year chart, it looks similar to like this 2014 to 2018 period. This time it was 3 years. Back then it was 4 years. And basically that was about 1,400 of gold, which was about 130 to 135 on the GLD. And when that broke, you can see what happened. You basically had this huge run when it broke here. That lasted over a year and took gold up nearly 50% in price. And obviously the gold shares did a lot better. So and then we'll get into our sponsor company, because we do think gold's going to move. For paying members, I talked about a bunch of gold stocks this past weekend, etc. So Carlyle, which has done well in the last few weeks, many of you participated in the 8.5 cent financing. I've gotten my average price in Carlyle down to around 12 to 13 cents through kind of the combination of doing that financing and averaging down in the 8 to 10 cent range when it was there this summer. So we can see here that they're going to test the higher grades near surface stuff. They're going to test historical setup locations to increase the inferred resource, testing a new unit in the northwest area of the property, and of course, obviously, define the resource and expand it in the coming days, and in the coming months. So that is kind of it. There'll be 7 drill holes, 1,500 meters of drilling, average depth of 200 meters per hole. This project is a little more at depth than other projects. So it only has a $5 million market cap. So I really like the company still here, and anything south of 20. For those interested in financings, they might do another financing because they have to fund this drilling. So if that does happen, you might want to do it. I might participate a little more myself. The 8 cent financing was about as good as it got. I like the chart a lot. Carlyle is finally on stock charts. I think it's CA here. Yeah. So it's finally on stockcharts.com. So I don't have to go to bar chart to look at it. And again, you kind of look at the 1-year chart of it. Again, this is a kind of chart I really love, where you have this big base here between about 10 to 13 cents. It broke out of the base. Now this 15-cent area is kind of probably will act as support, I think, before we move back up, hopefully, to kind of like that 25 to 35-cent area where it was earlier in the year. And again, we're in that seasonal timing. See, last year, Carlyle went from about 20 cents to nearly 40 cents. So let's hope we can see a similar kind of move here going forward. So again, their sponsor stock chart today. I've had marketing agreements with them in the past, and I do own a stock. This is probably my largest junior holding at the moment, and a Regency being my second largest as well. So Now we're going to go into the stock market because this is our extended our one for the weekend. So this is from Equity Clock, a great site, equityclock.com, run by a friend of mine named Don Vialu. And it shows this is the best 6 months of the year seasonally for the stock market from October 27th into May the 5th. And you can see on the most part, and the returns are positive. There's a few, like, in 2022, when we were in a bear market, the market fell 8%, but it was up in 2020 to early 2021, up 22%, up 10%. Here it was down 5% because of the big COVID crash. May 5th, you see, up most of the time. 2008 it was down, but of course, if you had gotten out in 2008 and bought, in late 2000, you're going to miss the majority of decline in the markets. Of course, you always have to play this by year because, like, in 2020 and in 2009, you saw a big swoon into March, April. So that was probably a sign that the market would do well over the spring and summer. So you always have to play this with a grain of salt, but you can really see that this seasonality works. Like in the 80s, it was fantastic. 85, 86, 87, 88, especially 86 to 87, because you would have missed the last market spike into the summer, but you would have missed the crash entirely too. Of course, when you get these fall crashes again, like 2008, that's when this really worked. Okay, from 2007 to 2008, you would have lost 8%, but that was nothing until it was come. And then, this worked there. So this is usually when it happens. So I'm still keeping some shorts here. I'm cheating a little bit. Usually by the end of October, I was going to get up a whole bunch, but there's two things that are going to happen. The Fed meets on Wednesday, and then Microsoft reports on Thursday. And Microsoft seems to me to be the weakest of the so-called Magnificent Seven stocks. Apple reports on Thursday. Apple seems to be the weakest. They're not seeing the good sales in their new iPhone. They're really behind the ball in their AI integration. So they're going to have to spend money, which is going to cut into their margins. Apple just got old and lazy. They decided to do stock buybacks and financial engineering instead of investing in new technologies like AI, et cetera, right? So, and I can see, like, I got a MacBook, my in Canada, a new one, and I don't really see a huge improvement. There's some stuff like the camera's better, but I don't see a huge improvement in this MacBook over the one I had, years and years ago. Everything's a little faster and the whatnot. So I think that will be interesting. So I'm willing to wait a couple more days, basically give it another week, to see because I expect the Fed to be quite hawkish, especially with the housing numbers and the GDP report being strong last week. So that could, kind of turn us lower. But here's the thing, November to, December declines, like 2000, 2008, 2018. We'll go look at the S&P in those areas, or at least one of them. Let's go look at it in 2018. I think I'll do this. I'll save this for the next week's more detailed one, but I will look at 2018, and I'll show you the other ones. So when the market does decline in the fourth quarter, it tends to be very choppily. 2018, again, by the end of October, about half the decline was already in. And then if we go look at it, we'll go zoom into 2018, and you can see it was like here, then it was up and down, and then the last move up, and then the market had basically taken back those losses by the end of the first quarter. So that the issue I have with these kind of fourth quarter declines is they tend not to be like very vicious declines. The vicious declines happen in that September to October period. So I would think that what I'll be looking to do is I'm going to wait and see what happens in the market this week after the Fed, et cetera. And if nothing happens, I'm just going to get out a lot of shorts and kind of await and see what happens going forward. Again, look at the fourth quarter 2019 as well. So usually this strategy of kind of getting out a short in, even in 2008, when the market kept going into Thanksgiving, it rallied in December. In 2007, when the market topped in October, it rallied in December after having a short-term bottom in around Thanksgiving of 2007. So, usually, again, it's just the whole time frame of getting into the holidays, kind of the same thing in the summer, holidays, especially July in the summer. It's just not the seasonal time for a market decline. See, a lot of this stuff has to do with psychology and the way people feel. Like in that September, October period, the weather's getting bad. It's getting colder. People are, have to go back to work. They're finished their holidays, and they're kind of in a negative, mood. And I think that it spills over to the stock market, and that's why these crashes happen in September, October. Same thing, the market weakness that tends to happen in the first quarter. It's that, again, people are out of the holidays. They spend a lot of money at Christmas time. Obviously, you're in the middle of winter, so the weather's not good. They've done their probably a little, winter Christmas vacation to somewhere more tropical, and people just are kind of in that sour psychological mood. So anyhow, just going to finish off on that. I showed you gold. Looks good. Of course, we're in the strong seasonality of gold. We are now entering the stronger seasonality for the stock market. So that's why I'm probably going to take some shorts off. Because even if there is a choppier, and even if we do continue lower early next year, kind of like we did in 2007, 2008, or that kind of, or 2000 to 2001, I think the big decline will really begin sometime in December or January into the year. And look, I'm not as, now with gold stocks and it's showing signs of bottoming, I'm not as into trying to pick every short in the market, like, short every rally, looking for a few percent. Now I think because in 2000, the better move was to buy gold stocks, right? Fourth quarter of 2000, rather than short the market. Even though you would have done well shorting the market for the next year or two, you did way better in gold stocks over the next 5 to 7 years in 2000. So that's kind of where I think we are now. Now the opportunities are there in gold and precious metals and other commodities. That's where I want to be. So I will pick selective shorts. It's always good to have a few hedges, but I just think now is the time to, like I said, my whole thing of this shorting was, if it didn't happen by late October into early November, sometimes these declines can spill over to early November. Like the low in 1929 was actually a week or two after the crash in November. The low in 2008 was actually, again, around Thanksgiving, really a month after everything crashed. There was one more lower low in 1987. After the crash, the market retested those lows in early December. So there can be these lows, but really, for the most part, even if you do get a decline in the fourth quarter, it's not a watershed decline. It's more, a slow decline. So I'm going to leave it at that. I hope you enjoyed this extended version, and we'll go back to some stock charter days, the regular ones for the rest of this week, and then next weekend I think I'm going to go look at those fourth quarter declines, because or those November, December declines. We'll look at the history of them next week.